Welcome back to the Global Ledger. I'm Justin. Over the last several episodes, we've been building a bridge between money and valuation, between how markets are funded and how assets are priced. Today, we arrive at one of the most famous and most misunderstood models in finance. That is the capital asset pricing model, CAPM. It's taught as a cornerstone of modern finance. It's embedded in valuation models really everywhere. And yet, almost no one agrees on whether it actually works. So today, we're not asking, is CAPM right or wrong? We're going to ask something a little more revealing. And that is CAPM really a model of markets, or is it secretly a model of funding conditions? Let's get into it. What does CAPM really claim to do? At its core, CAPM says really something very simple. The expected return on an asset equals the risk-free rate plus compensation for systematic risk. So in equation form, it would be expected return equals RF times beta times market risk premium. And where RF is the risk-free rate in this linear equation, B is the beta, which measures sensitivity to the market. And then the market risk premium really is the excess return investors demand to hold that. So this looks clean, mathematical and an objective. But I want you to pay attention to one of the first cracks. CAPM assumes that markets are already liquid, integrated, and frictionless. It doesn't ask how risk is funded. It assumes risk can always be carried. That assumption matters. And so CAPM seems to fail or struggle empirically. So beta doesn't explain returns very well. Low beta stocks often outperform. High beta stocks often disappoint. Risk premiums shift dramatically over time. And this led to multi-factor models, size effects, value factors, momentum factors, endless regressions, etc. But notice something important. All of these anomalies appear during changes in funding conditions. Not during changes in technology, not during changes in long-term growth, but during liquidity cycles. That's really our clue. So if we reframe CAPM, looking at it maybe a little bit more through money and funding, the key question in that view never is what is risk. The real question is, who is willing and able to hold risk? Risk is not priced by abstract investors. Risk is priced by balance sheets, and balance sheets are constrained by funding costs, repo availability, margin requirements, collateral quality, dealer capacity, volatility. So what does beta really measure then? Beta is not just market sensitivity. It's sensitivity to funding stress. High beta assets perform poorly when leverage is being unwound, balance sheets are shrinking, and dealers are pulling back. Low beta assets perform better because they are easier to fund, easier to hedge, easier to warehouse. CAPM doesn't, fail. I just think it might be a little incomplete. So, which brings me to talk about why the risk-free rate is not risk-free. CAPM begins with the risk-free rate, but in the real system, the risk-free rate is a policy-anchored rate transmitted through repo, reserves, and treasury markets, shaped by even collateral scarcity and dealer intermediation. In other words, the risk-free rate is a funding rate. When funding is abundant, the risk-free rate is stable. Spreads compress. CAPM appears to work. When funding tightens, though, repo rates spike, collateral haircuts rise, risk premiums jump. CAPM starts to look a little broken down. Again, not a market failure, a funding failure. So if you look at the beta as a balance sheet variable, here's what I would want you to take away as kind of the key insight for episode 46, today's episode. Beta is not a property of an asset. It's a property of the financial system holding that asset. Beta changes when leverage changes, volatility changes, funding changes, dealer balance sheets expand or contract. These are kind of the things that would drive changes in the beta. This is why beta is unstable over time, not because markets are irrational, but because funding conditions are dynamic. CAPM assumes static funding. But when we look at it through a different lens, more of a money lens, it starts to reveal more dynamic funding, you could say. But let's tie CAPM in and look at it in a global dollar system. If we scale it globally, because global markets are funded in dollars, dollar liquidity conditions, FX swap markets, cross-currency basis, offshore dollar creation, all influence risk premiums everywhere. This means CAPM is implicitly a global dollar funding model. When dollar funding tightens, emerging market betas explode, global correlations will spike. You see failures in diversification. This is not a flaw, in theory, I guess, but it's the system revealing itself a little bit. So I really look up to a lot of individuals, and there have been a lot of people that I have learned from over the years that have really spoke to me, and I will do probably a series on these people, just because I'm extremely grateful for the knowledge they've shared with me. And I say that because if you go online and you search CAPM, there will be a professor. His first name is Aswath. And I love his work. And I'm a huge fan of his. And so I believe he was right. But I think there might have been something missing, maybe. One thing he says is models don't fail, people misuse them. And I believe that's 100% correct. CAPM is useful, but I think it's useful only if you understand what it's actually modeling. It's not a timeless law of markets. It's a snapshot of liquidity conditions, funding costs, balance sheet capacity, used blindly. CAPM could be a little misleading. But if you look at it from more of a money market and liquidity standpoint, maybe it clarifies a little bit. But again, this is my opinion. All of these things are my opinion. So when you start to look at the plumbing of the financial system, you can see what CAPM starts to look like. Once you see the system clearly, CAPM becomes conditional, not absolute. Betas become a liquidity proxy. Risk premiums become funding premiums. And valuation becomes really a monetary phenomenon. So CAPM, I'm not saying CAPM is wrong. I just think it's incomplete without money. I want to thank you for listening to episode 46 of the Global Ledger. We reframed CAPM today, not as a flawed market model, but as a partial reflection of funding conditions inside a balance sheet constrained system. In the next episode, we're going to push this a little further. In episode 47, we're going to talk about liquidity adjusted VAR and how risk actually behaves. Because risk isn't static, it moves with funding. Once again, I'm Justin, and thanks for being here.